And thank you for joining me today in our daily trading room. So today we are going to continue going over the vertical bear put, bear call, bull put, and bull call spreads. Let's always remember that when you buy low, sell high, that's a bullish strategy. When you buy high, sell low, that is a bearish strategy. So let's go over what happened in the market today. Well, remember, this is part of our daily routine. We want to check the ETFs first. So this will be the SPY. So what happened on the SPY today? Today it's a bullish candle, very small, kind of stayed in a narrow trading range. If we look at the 1 day, 1 minute, opening right around 441 and closing around 442.68 as it got as high as 443 and then came back down. Okay, let's look at the IWM. IWM for the 6-month 1 day, same, a very small candle. Okay, see, I'm gonna exit off of my simple moving averages so I can see it. Yeah, so now I can see more of a chart. IWM has been moving kind of like within this $15 range. Low of around, no, the low got us down to 210, but it's kind of staying in this range between like 216-ish to about a high of 230 for almost the past 3 months. This is a really good trend right now to put on some bull put bear call spreads, which is also known as the iron condor. So in order to set that up, when you see the IWM bouncing off of resistance to the bouncing from resistance and coming back down, that's the trigger to put on a bear call. And then when it bounces off of support to the upside, that's the trigger to put on a bull put. Having a bear call and a bull put on is called, especially when it expires at the same expiration, that's called an iron condor. Of course, you may not want to put both the bear call and the bull put on at the same time, just because to increase the probability of the trade, you want to be able to get above resistance for your bear call spread and below support for your bull put spread. So you actually want to do something called legging in to the trade. So let's see, let's draw this out because this is a really nice chart for an iron condor. Okay, so this is a 6-month 1 day chart. Let's see, the first time I would consider putting on a bull put would have been probably on 3.4 or 3.5. Okay, so 3.4 when it sold down here, and then 3.5 when it bounced off. I would have put my first bull put on right here. Okay, so let me draw what that looks like. So draw this candle here. Okay, so I would have put a bull put on right here. Let me type that out. Okay. Then it rallied up to this 232 level. I can even increase this right here. Let's go. And then once it sold back below this, I would have put my bear call on probably, yep, on 318. Let's draw that. Read this candle here. Okay. This would have been my time to put on a bear call. And then it came back down here. So my bull put, if I put on the expiration of March 19th, and this being 3/5, I probably would have got close to 80% right around here. If not, if I didn't hit it, I would have been very close. This bear call, I wouldn't have waited for the whole month just because the market has been so bullish. So I would have put an expiration of around 2 weeks, something expiring like right around here, like around like a April 1st expiration. Then when this came back down and dropped below this 216 level, let's see, here's another level of support, which is like right around here, 211. So once I saw this candle break through this 216 and then 325 is when I would put another bull put on. So that would have been a bull put right here. Okay. So then I wouldn't have put anything on here. Maybe and this would have been the expiration on April 16th. Would I have put on a bear call here? In this candle here, if I can get above resistance, on this candle, if I can get above this 232 level, then this is where I would put a bear call on, right here. Oops. Okay, then this candle here, would have been a bull put. So this is legging into an iron condor, okay? Okay, then when it came back up here, it hit this level of resistance and sold back down. I would have put my bear call to stay here. Okay. So let's see. I could have put on a bull put right here, but I feel like this is too tight on price, especially because I know that it has come down to this level of support over and over again. So I wouldn't have put a bull put until I see that it crosses down below support and then bounce back up here on this date here. Here. or you could put it here on this day here. So either on July 16th or July, let's see, what day is this here? Let's see. This is July 20th or July 19th. So July 19th or July 20th, I would have got back into another bull put. Okay. So this is 1, 2, 3, 4, 5, 6 trades on. So 3 bull puts and 3 bear calls in the past 5 months. But these would have been successful because I'm putting my bear call above resistance and I'm tucking my bull put below support. Okay, that is the key to these iron condors working. I actually have a bull put on the IWM now. I don't have a bear call on because when I did put the bear call, it's been a long time. I could have put another bear call on here. On, let's see, I would probably put one on here. You might be able to get away with a bear call there. Okay? Okay. So the IWM is running through this channel right now. It's just kind of hanging there through this price levels from 210 to around 230. Okay. So when you see this, iron condor is going to be the best strategy to put on. Okay. Okay. Let's move on. What happened in the DIA today? Okay, so the DIA had a little small pullback yesterday, and then it had a bounce. I actually put on a bull put spread expiring in September today, selling I believe the 345, which is here. Selling the 345, buying the 340, which is right here. So I'm hoping that the Dow will hold this level of support. Well, yeah, this level of support all the way until expiration or until it gets filled at 80%. Okay, so that's the DIA. Then let's see what happened in the Qs today. So the Qs had a little pullback, and I think it has something to do with the interest rate. So I wouldn't, you definitely want to listen to what's going on in the news to see if it's favoring technology stocks or what sectors are winning out. And you would, of course, want to defer to your watch list so you can see that. But the XLK, which is the technology sector, probably had a little pullback today. As you can see, it did. I would expect, and then we know, like if we do our Fibonacci's to see where it would trace to, I like to do my Fibonacci's on a 1 year, 1 day. So I go to the close at the top side to the open on the bottom. Okay, make sure your lines, your vertical lines are as straight as possible. I don't think it's going to come all the way to 145. No. Let's see what our simple moving day averages look like. So actually it stopped right at the simple moving 20. If it goes below this simple moving day 20, it's probably going to stop at this level right here, 148, which is right at the 50, which will be very painful for a lot because this is the tech sector. Okay. So I know the XLB, which is the materials, that was really bullish today. There was some type of infrastructure bill that passed in Congress. So that's really going to benefit the materials, the industrial sectors. So those are the stocks that we want to look at. Remember, we always want to track the money flow. Where's the money flowing into and where's the money flowing out of? So as far as the XLI, which is the industrial, we see it did have a bounce. So actually right now, you can almost consider putting on a bull call spread to get to 105. This may be like $1 wide, $2 wide, maybe the 104, 106. Give yourself a couple weeks. I mean, look at the XLI right now. So we see the XLI is both above the 50 and the 20 moving day averages. It bounced off of which is acting as support. And it looks like it's trying to go back up to maybe the previous high, which was 106.81. And that is the industrial sector, which will benefit from this infrastructure bill. And we see the volume. It was high volume, nice bounce. Could totally do a bull call spread on this. Bull call 104, 106. Okay. You can even probably do it for the August 20th expiration. Okay, so let's put this trade on. The market's closed, so we can't trade options, but we can at least put it in our working order. So I'm going to put the XLI expiring August 20th, the 104, 106 bull call spread. 104 to 106, hold the control button down, click on the bid, get me an 81-cent debit. I'm going to do 5 contracts. Confirm. So I have to go to GTC because the market's closed. So right now, this trade is going to be working. Okay. All right, let's see another sector. XLV, which is our healthcare sector. It's kind of flat. XLU, which is the utilities. XLE, which is energy. Okay, energy is bouncing today. And it's bouncing off a high volume. It sold off quite a bit from its previous high at 56. And it got above the simple moving 20. You could totally put on a trade, maybe doing a bull call spread, buying the 49 strike and selling like the 51. I don't know how much you get paid for that, but you could totally put it on that. Okay, so yesterday we talked about bull put spreads. I wanted to show you one of my prescriptions for success, the trading recipe for a bull put spread, okay? Okay, so I title all of my trading recipes, okay? So this is a bullish monthly bounce bull put. The objective of this trade is to trade a bullish bounce off of support. For my watch list criteria, I need liquidity, the average daily volume greater than 1 million shares. I like to do mine on equities that are greater than $100. They just seem to move more, and I'm able to get out of my trades earlier with the 80% gain. The stock needs to be above the simple moving day 200 for me to get in there on the trade. So what is the trend? The trend has to be an uptrend. It's making higher highs and higher lows in the short term. So these are the most profitable stocks or equity or ETFs that I put my bull puts on. I try and have minimum of 8 bull puts every single month. My goal is to get 20 to 25% on my bull put spreads. So I usually like to do about 10 to 12 contracts. So as far as the entry rules, so when you have when you're putting on a certain trade, you want to have rules that you can follow over and over again. That will help you stick to the process, and so you're not changing your trading strategy in the middle of the trade. Okay, you want to put on the trade, know that you did the technical analysis correctly, and follow your plan. So according to this plan, entry rule, all rules must be present to proceed. I need to have a bounce off support to the upside. And this needs to have a higher low or equal low than the previous day's candle. The chart is making higher highs and higher lows. That's a setup. And you want to know if you're closer to support or closer to resistance. If I'm close to resistance, I don't put on the trade. Why? Because it can bounce off of resistance and then come back down and breach my short strike, which I do not want. So the entry is going to be the candle. I need a close above the high of the low day. Okay, let me show you what that looks like on the chart. Back to XLE. Okay, so a close above the high of the low day. So here, this candle on July 19th is considered the low day. Why is it the low day? Because it's the lowest candle in this trend. This candle closes above the high of the low day. So this will be my trigger candle, my setup candle to enter a bull put spread. Okay. So this candle here is the hold, close above the high of the low day. Okay. Okay, so when do I enter? I enter any time of the day if the volume is above the daily above the daily average. I might want to take advantage of the momentum, or you can enter any time after 3:30 if the technical signals look bullish. You want to sell time for 1 to 4 weeks. You give yourself greater than 7 days, but up to about 28 days. Okay, those have been the most successful trades that I have seen in my research. Okay. You want to sell a delta of 30 to 50. Anything above a 35 delta is aggressive and more directional. Okay. So let's say you're having a really big bounce and you sell a higher than a 35 delta. This is more directional and it will give you a bigger premium. Okay. It decreases the probability of your trade being successful because the delta is also the probability of that strike being in the money on expiration. And when you're doing these bull put spreads, you want both strikes to be out of the money. Okay. So the difference between the bid and the ask, of course, you want that to be less than 10%. And some considerations not to enter is if it's less than 4 weeks before earning. Okay. Okay. Let's go down. Oops. Okay. So exit rule. I assess the trade after 75% of the trading days have passed. Let's say my trade is successful and 75% of the trading days have passed. That's when I really tend to start looking at my bull put spreads, or if I'm losing on the trade. I usually will exit the Monday or Tuesday or Wednesday before expiration. Okay. The weekly spreads, my weekly spreads, I can let go to expiration because I'm only in it for a week. So I want to sell deltas 25 to 35. If I do that, then I set my limit price to 70 to 80%. Now I've just been doing 80%. So how does that look? You credit, so to set your limit order to 80%, it's your credit. You multiply that by 0.2, and that's what you would set your limit order to. Let's say you want to sell a higher delta. You want to set your limit price to 50 to 60%. Okay, because this is a more aggressive trade, selling a 35 to 50 delta. You're going to get a nice premium, so you don't need to wait for the 80%. You just want to get out at 50 to 60%. Okay, unfavorable exit. If the stock decreases below strong support or an area where it changes trend, you want to exit the trade. If the stock goes below your short strike and there's less than 2 weeks until expiration, exit trade. Okay. You don't want to take a max loss on these bull put spreads because of the reward to risk profile. Taking a max loss on these is wiping out about 3 to 4 of your bull put spreads. Okay. Don't put them on through earnings. Okay. So let me show you especially why you don't want to do that. So look at what happened in this trade. Amazon has been just killing it this whole time. Usually when it has earnings, well, it did go down here. But nobody expected Amazon, after they had such a blowout earnings, to drop down 300 points. And that's exactly what it did. And it hasn't gone up yet. So actually, when this happened, when it dropped down to here, the price of the puts were so inflated, you could have put a bull put here under this simple moving 200, which is a riskier trade. So you could have done, as soon as it had to drop like this, you could have put a bull put on like this, which is increasing you. So this will, I personally think this will be a successful trade, but because it just had earnings and dropped down so much, you would want to wait for some kind of confirmation before you put a trade, because of course it can keep going down, right? How low can a stock go? It can go to zero. Do we think Amazon's going to zero anytime soon? No, we don't think it's going to zero anytime soon, but nevertheless, it dropped down 300 points after earnings. So I would wait for this candle here to get into a bull put spread on Amazon. And as long as I tuck it under support, once Amazon is doing this right here, my bull put might look like in my account like it's losing just because the price of the puts are going up. But just as long as it's trading above my short strike, I'm fine, right? So if my short strike is like right here, my long strike is right here, just as long as it's trading above my short strike, I'm making money on the trade. Once it starts to come down, 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 it might look like I'm losing money, but the trade is still a successful trade. Why does it look like I'm losing money? Because the price of the puts are being inflated. Okay? Okay, so for the bull puts, I can trade up to 1% risk of total account per trade. Okay, so I put this on my account because I trade on $300,000 account. So 1% for that for me is, I can risk $3,000 on my account per bull put spreads. So you don't want to risk more than 5 to 10% risk of a total account in any symbol. And that's what I was talking about, telling you about the IWM, how you can stack like your bull puts, your bear call, your bull put, your bear call. It's okay. You can risk more if you have both bullish and bearish trades on. Because let's say IWM, it crashes, then you lose on your bull put side, you're still going to make money on your bear call side. Okay? And you want your portfolio to heat to be less than 30%. What is portfolio heat? What if all my trades lose? Then I can't lose more than 30% of my portfolio. Okay? Obviously, I've never had this happen to me before, but it could definitely happen. So watch out for it. Like the day that, you know, COVID, that March 2020, if you had on a lot of directional trades, especially, you probably lost a lot of money because it crashed so much. And let me show you what that looked like. So if we go back, let me see, go back 3 years. So this is a chart of the SPX, which is the index fund that follows the S&P 500. On February 17th, you had a little bit of selling. Then we found out, you know, COVID's rampant, probably got to close, up a lot of businesses on February 24th, and then the selling began. So once this selling happened, if you were in some long calls, because I mean, look at this trajectory. Let me clear some of these drawings off. These are all notes. See what that is. Okay, so once this selling started happening, I mean, look at this trend. This would have been a nice trend if you had like some just bullish trades on. But if you would have put on some bullish trades, you would have put them on like right, let's see, right under 28.40. Okay, so this is what you could have definitely had a totally viable trade on, like here and here. So that would have been an awesome trade. If it did not get filled at 80% when it made this run and you're still in it past this expiration, this candle would have showed that your bull put would have been losing. However, it still stayed above the short strike. There was some buying on this day here on March 2nd, and then March 9th took you out. Okay. And even March 9th, it sold all the way down to a low of 24.93 from a high of 28.80. I mean, that's 400 points. That's a big drop. But then you get this long wick to the bottom. So once you got this long wick, you would think it's coming back up. You might have been tempted to put on a bull put somewhere here. You might have been tempted to put on a bull put somewhere here. When you saw this candle here. But oh no, the selling wasn't done. So this candle would have had you shook if you would have put a bull put. That's why it's nice to get confirmation. So what is the actual confirmation candle? The actual confirmation candle could have been March 23rd, or it could have been on, actually this is a week. Pardon me, each of these candles are a week. Let's do 1 year. Let's do 2 years, 1 day. Let's see. So we're going to change this to do 2 years, 1 day. So this is actually a better representation of what actually went on. Yep. So if I blow this up from here to here. Okay, so it was high of around 33.93, then sold off. So you had selling, 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 then a little bounce. You definitely could have put a bull put here. But then you would have been screwed right here. Okay? If selling, 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 you would have been tempted because you're like, why is it selling so much? But then you don't know that it's going to bottom out here. until you get maybe a candle like this here. So this is just a big down trend. It's not even, I mean, it's not even making lower lows and lower highs. It's just selling off. And these, I think that these green candles are here are probably like the bots, like that are triggering the buy level. So once a buy level is triggered from this selling, then they just buy up. Trigger is selling, buy. That's why you have sell, buy, sell, buy, sell, buy, sell, sell, and then back down here, it's like, okay, this is like manually buying, manually buying. Okay, so once you see like this sell, buy, sell, sell, buy, sell, buy, sell, buy, those are the bots that are being triggered to get back into the trades once you see so much of that selling. Those are like the Blackstone funds that control $1 trillion that are able to do that type of buying. Okay. Okay, so daily, so you want to journal your trades. You want to monitor positions and manage the exit rules, and you want to check the watch list for new setups and entry signals. Weekly, you want to analyze for effectiveness. How effective are my rules? And it's a pro tip. On all of my charts, whenever I have a bull put spreads, I change my short strike. I put a price level on my short strike and I change it to white. Okay, I also like to add my max gain and my max loss on each chart, like as a text note, so I can know exactly how much I could lose in a trade just by eyeballing it. Okay, I'm going to show you what that looks like. Okay. So right now, let's see, new share. Okay, so right now I have a bull put on Google, okay? I am short I'm short the 2660. I'm short the 2660 and I am long the 2655. $5 wide. It's kind of hard to see because Google is a $2,700 stock and this is 5 wide. But what I've noticed is I don't even like to put my long strike on there. I just like to keep my short strike because that's the one that I'm going to be assigned on the obligations. I change it to white for my short leg. And then I put alerts below level of support. Okay. So I create alert to alert me if it ever gets below my support. And then I'll put a text note on here. Max loss, 1890, max gain, 610. If you ever want to move it, you just say activate. And then I might change this, edit properties to yellow. Okay. So this is what I have on all my chart that I do my bull put. I have my short strike in white, and then I put a text note here. So once I eyeball this, I check the chart to see which one have my bull puts in it. I'll automatically see what this is, what my short strike is. I look at my phone that has my Thinkorswim app, and I see how close I am to my max gain, how close I am to my max loss. I already have the working order to get me out at 80%. But depending on what could happen next, like if it's a earnings or something, I might just want to get out the trade if it's close to what my max gain is. Okay. And that's my process of going through, putting on the bull put spreads. Okay.